the end of the bond bull market might signal the beginning of the gold bull market. And both markets are acting as though that's the case in the near term.
Are you tired of overpaying for your gold, silver, and platinum bullion coins and bars? Then visit sdbullion.com today. SD Bullion was recently named the 177th fastest growing company in the United States by Inc. magazine. This is because they offer the absolute lowest prices in the industry and follow up with over-the-top customer service. So what are you waiting for? Go to sdbullion.com today and join more than 60,000 happy investors that save money on every precious metals purchase they make.
Hey everyone, this is Elijah Johnson with SilverDoctors.com, and back with us today is Rick Rule, the president of Sprott US Holdings. Rick, thank you so much for joining us today.
Always a pleasure, Elijah. Thank you.
All right, now I'd first like to get your perspective on the massive stock market correction we saw last week. It was the worst week on Wall Street in 2 years. What do you think drove this correction?
Well, Elijah, from an old man's perspective, which clearly you're not, that was not a massive decline. It was a return to the sort of normalcy that I've come to expect in 40 years of investing. I will admit to you that by the standards of the last 2 or 3 years, with the VIX sound asleep, that this was a fairly important move. But the truth is, this was more the norm than the exception for most of my time in the market. And I'm not sure you could read anything into it.
All right, and I know that one of the things we've also been seeing recently, and you've talked about last time, is also the movement we've been seeing in U.S. Treasuries. The 10-year yield has been rising for a little while. Last time we had you on, you talked about how even though the U.S. Treasuries are seen as one of the most safe assets, you see it as just a depreciating asset because of inflation. So do you think now that we're seeing yields rise, do you think the bond market has hit its peak?
That's a huge question. It would appear, and again, I'm no specialist in technical analysis, it would appear that with the U.S. 10-year Treasury falling over 30 years from 15.6 to a low of 1.6, and now rising from that 1.6 to 2.9, this would appear to be a reversal, but God knows, I'm no economist. If it is a reversal, of course, that has profound implications for many asset classes. I've told you before in our interviews that I consider the U.S. 10-year Treasury to be the sort of benchmark security against which all other securities are valued.
So what do you think this means if this is a turning point? What do you think this means for other markets?
Well, conventionally, an increase in the U.S. 10-year Treasury is bad for many markets. Imagine, as an example, the implication of a 150 or 200 basis point increase in the 30-year fixed mortgage rate. Imagine what impact that would have on the affordability of residential real estate in the United States. Think also about the implications that it might have for the more mature U.S. equities markets. Traditionally, when the U.S. 10-year rates go up, it's bad for equities markets, and bad for two reasons. The increase in the bond yield raises the cost of capital for companies that borrow, which include most companies, which of course cuts into their distributable cash flow. It also lowers the value of a dividend stream relative to savings instruments. So traditionally, a rising interest rate has been bad for most markets. Never mind, of course, the bond market. If you can invest in a so-called riskless 10-year Treasury at 2.9, the inclination to take a lot of risk and incorporate it to maybe 3.2, that is a 30 basis point premium to the government bond, is non-existent. So traditionally, increases in interest rates have been bad for most financial markets.
Now, what about precious metals? How do you think, if this is a turning point, that would impact precious metals?
Well, you know my thesis that for 40 years, the most important determinant, not the only determinant, but the most important determinant in precious metals prices has been the strength, or at least the perception of strength, in the US dollar, particularly the US dollar as expressed by the interest rate on the US 10-year Treasury. If, in fact, the 35-year bull market in US Treasury securities is over, and if gold is most importantly denominated conversely, if you will, to the US dollar, then the end of the bond bull market might signal the beginning of the gold bull market. And both markets are acting as though that's the case in the near term.
Definitely. We've seen, gold and silver rise, although in the past couple of weeks, they've had a slight correction, just as the stock market has. What do you think is driving this correction in the precious metal markets?
You're getting me out on the very, very, very edge of my perceived confidence. But since you asked the question, I'll give it a shot. My suspicion is that gold and silver are still regarded globally as fringe assets. The value of gold and silver holdings relative to, as an example, currency holdings or equity holdings or bond holdings are very, very small. And if you have periods of time when increasing volatility in the market leads to shortages in liquidity in peripheral markets, it's hard on all the peripheral markets. This can include gold and silver, emerging market stocks, high-yield bonds, that whole class of investments that are regarded as peripheral assets tend to do poorly during periods of volatility, particularly periods of volatility that are accompanied by a shortage of liquidity.
Now, as for the mining sector, we've also seen a slight pullback in the last couple of weeks. The GDX is down ever since about January 24th, so 2 or 3 weeks ago. So where do you think this is a bottom for mining stocks?
I could see the mining stocks go lower, but I have to tell you, I think the precious metals mining sector will do relatively well in 2018. Not as well as 2016, perhaps, but relatively well nonetheless. And I think this will occur for 2 reasons. The first is that the sector, that is, the shares, underperformed the metal fairly substantially in 2017. And so I think a little bit of a bounce is due just in terms of catch-up. But probably more importantly, sectors move when the sector itself exceeds expectation. And expectations in the mining equities are so lousy that I don't think that the sector could possibly not exceed expectations. At the same time that expectations are low, there has been a renewed focus in the executive suite among gold mining companies to exhibit intelligent capital allocation and good returns on capital employed. So the sector is focused on financial parameters more than they are leveraged to the price of gold in a way that should create the type of performance that will help exceed those very, very low expectations.
Now, for those investors who are wanting to invest in the precious metal sector, where do you see the most gains coming from this year? The mining stocks or the physical metal?
I think the best risk-adjusted gains will occur in the equities this year. You'll recall last year I suggested that people go into the physical metals rather than the equities, following, of course, a very strong year that the equities enjoyed in 2016. My suspicion is that people should shade their bets to the equities, the exception being those investors that have no presence in precious metals or precious metals equities at all, in which case I suggest that you start your portfolio with the metals rather than the equity.
All right, now moving to our last topic, if we could discuss about the U.S. dollar, because we've seen the U.S. dollar drop recently, and it looks like it could be falling off the cliff. If you did just a little bit of technical analysis, we had something up here on silvervectors.com. There was a little bit of technical analysis on the U.S. dollar chart. Where do you see the dollar heading?
Elijah, if you give a good salesman like me the use of a word could, I can sell you anything. The U.S. dollar is interesting. Our mutual friend Doug Casey has described it as the prettiest mare in the slaughterhouse, meaning that a lot of its strength has been due to the weakness of its competitive peers. And the US dollar has outperformed most other fiat currencies really since the 2008 financial collapse. And it's probably due for a rest at any rate. But the truth is that the news out of Washington in the last 2 or 3 weeks, not that you need to believe any of it, but the news out of Washington in the last two or 3 weeks can't inspire confidence in the dollar. The tax cut, while tax cuts are a good thing, not accompanied by a spending cut, that's a bad thing. Adding to $1 trillion current deficit this year, $300 billion in the bill that's now in the Senate, and putting on top of that the Trump administration's actual call talking down the U.S. dollar, saying it would be useful economic policy, at the same time that they propose spending $1.5 trillion for infrastructure that they can't afford. Who in their right mind wouldn't be nervous about the dollar, with that kind of fiscal leadership coming from the political elites and frankly from the voters?
Definitely, but is what you're saying that it's still the prettiest one among the currencies?
Well, I think that part is true, actually, Elijah. Obviously, from my viewpoint, I like an allocation of gold and silver to protect yourself from the political idiocy around the world. But the truth is that when I compare the fiscal stewardship in the United States with fiscal stewardship in places like the European Union, Japan, and many of the emerging markets, all of a sudden I become more tolerant of our idiocy when you put it in the sort of communal idiocy that the political world worldwide seems to exhibit.
So as for the future of fiat currencies, I mean, do you have a idea of where they're all going in the future? I mean, do you see if the dollar is going to collapse, then wouldn't it mean that probably all fiat currencies would collapse?
I don't see the dollar collapsing anytime soon. I see too much faith in the status quo, too many people wedded to the status quo. I see too many people thinking that the solution is a Democratic solution or a Republican solution or a statist solution, some sort of political solution. And I don't see any of those solutions.
So maybe not, a complete collapse, but just possibly some people losing some confidence in currencies?
Well, I certainly could see that. The circumstance that I came of age in when I was your age was the 1970s. And while the dollar wasn't destroyed, it was certainly battered. The U.S. 10-year Treasury, that so-called riskless instrument, cost investors about 80% of their invested capital over that decade. The gold price went from $30 to $850 an ounce. It was truly a trying time. A circumstance, a repeat of something like the 1970s. I'm not saying it's going to happen, but it could be very much in the cards. The truth is that if we had a circumstance that was 50% as dramatic as the circumstance that we saw in the 1970s, while it wouldn't be catastrophic, it would certainly be traumatic. It would, of course, be sadly pleasant for people who were prepared for it. But that, of course, doesn't take into account most of society. The real bad news about a 1970s-style circumstance, of course, is that, ironically, our society, our government, and individuals were much more prepared to take turmoil, much more used to turmoil in the 1970s than we are today. The only less fragile or more anti-fragile sector is corporate America, which took a real scare from the 2008 financial circumstance. Corporate balance sheets are in much, much, much better shape than they were at the middle of the last decade. But I'm afraid other parts of U.S. society, the federal government, state and local governments, and individuals are in much worse shape than we were to stand events like we saw in the 1970s than we were in the 1970s.
All right. Well, Rick Greuel, president of Sprott US Holdings, thank you so much for joining us today. Before we let
Always
you
a
go,
pleasure.
before we let you go, did you want to share with the viewers any last thoughts you had and where they can find you online?
Yeah, I would, of course, love it if people who were interested in this line of thinking exposed themselves to it more often. You can get our blog for free. It's Sprott's Thoughts. Go to www.sprottsthoughts.com or come visit us at sprottglobal.com. There's about 200 hours of instructional material on natural resource and precious metals investing there. I guarantee that your listeners will get their money's worth because it's absolutely free.
All right. Once again, Rick Rule, thank you so much for your time.
Thank you, sir.